everybody, and welcome again to OECD's Global Forum on Digital Security and Prosperity. Happy you joined the session on cyber insurance and catastrophes. Digital economy is thriving with an emphasis on data economy and is much dependent on trust and security together. While security is the objective, resilience is the goal, stability in the gushing waters of digital prosperity. The cyber insurance industry is growing rapidly. Take-up rate has doubled over the past 5 years. Now, the business needs to price and transfer cyber risk is clearer than ever before. It is also becoming clear that insuring digital risks is a new and exciting challenge for more and more people, making it an industry mission to allow optimized and resilient growth for the digital economy, presenting the ability to suffer big losses and to recover quickly, thanks to fair distribution of risks by an insurance mechanism. The past year hasn't been easy on the cyber insurance industry at all. Some industry leaders report that direct loss ratio rose to over 100%. Ransomware has proven to be an ongoing cyber catastrophe, aggregating more and more losses resulting from the same attackers and same attack vectors. Dazzled insurers find the extortion demands simply undigestible by insurance logics, and at least one insurance giant has already declared ransomware is uninsurable. Other insurers are forced to raise premium by over 20%, reflecting the true price of failure to secure our information systems. Some insurers report reaching the end of their capacity, simply without any cyber risk appetite left. This past year has also revealed a trailer for other cyber systemic risks. The Colonial Pipeline, for example. The Colonial Pipeline attack has demonstrated how a 4-day-long interruption to operations of a critical infrastructure could result in an expensive chain reaction. Cloud computing has been named the biggest single point of failure in human history, despite the obvious security advantages. And furthermore, the compromise through SolarWinds automatic software updates has affected over 18,000 companies directly and simultaneously, and jeopardized government entities. And here in Israel, it has been published that the OECD has prevented several massive malware outbreaks, and we have also recently modeled such a cyber epidemic scenario on the national level, quantifying some tail risk sub-scenarios to cost over 10% of our national annual budget. For now, some of these events are all excluded from most cyber insurance policies, and some allow only limited coverage out of a big total loss, leading to businesses and governments to bear the true risk alone. As more and more businesses' operations are digitalized, these exclusions just might make insurance irrelevant for the digital age. Putting on the glasses of an insurer rather than a securer allows us a higher and a strategic perspective on global cybersecurity, to rethink the public policy problem here and reorganize the scheme of developers, users, securers, and exploiters as well, and to formulate an adequate allocation of responsibility, reliability, standards, and introduce surety to users of critical infrastructure, common software, and platform services. In this session, we wish to explore what are these cyber catastrophes, their impact on digital security, and the progression of cyber insurance, and what could securers, insurers, and governments do and can do to promote resilience through the cyber insurance market. Great to have you joining us. My name is Itai Benartzi, and I lead policy design for INCD, Israel's National Cyber Directorate, and I will be moderating this panel of industry and policy experts. With us today is, first, we have Ms. Bobbie Stempfley, Vice President and Business Unit Security Officer at Dell. Hi, Bobbie. Good morning.
Hi. Good morning.
We have Ms. Maya Bundt, Head of Cyber and Digital Solutions at Swiss Re. Hi, Maya. Peter Armstrong, a Director at Cyber Risk Insights. Hi, Mr. Eli Levite, a Senior Fellow at Carnegie Endowment for International Peace. And last but not least, Leigh Wolfrom, a Policy Analyst in the OECD's Directorate for Financial and Enterprise Affairs. The conference audience and myself are all eager to learn from your experience and thoughts on this issue. So for the first round of questions, I will turn to Bobbie, Maya, and Peter. Please, each of you, please indicate your view on how to frame this problem of insurance and catastrophic cyber risk, and what it is you think that different players should do in order to manage the catastrophic potential. Bobbie, you first.
Thank you, Itai. I appreciate the opportunity, and I think your examples are really profound, right? When I think about 2020, one of the key set of actions that occurred in 2020 were major cloud outages and central service outages that sort of underlied a great deal of our efforts as we were simultaneously moving to be incredibly dependent upon all of these central services as a world, as a global enterprise. And obviously, 2021 is the ransomware threat has only escalated throughout that period of time. And so when I think about the consequences here, I also put it on the backdrop of how the technology is evolving. And so concentration is only growing in this space. 5 vendors account for 80% of the global market share in infrastructure as a service. 5 vendors account for 55% of the market share as software as a service. So we have fewer and fewer vendors and more dependence upon them as we go, as we move forward. When we think about platform as a service, that's still a highly complex space with a large number of vendor activities. But each of our individual enterprises are depending on many of these external vendors for operation and execution. And so the complexity we're all experiencing individually is never going to be any better than it is today here. And so really understanding those pieces becomes incredibly important. Now, saying this, it's going to sound like the next thing I'm going to say is almost directly at odds to it, but they're actually well aligned, and that is what we're seeing in this age of data is a desire to process that data closer to where it's collected, right? More at the edge. Now that sounds like it's the inverse of the convergence. In fact, the way the architectures are being put in place, it's oftentimes not. And so if 75% of the data is going to be processed at the edge in 2025, how is that processing going to occur? How many different architectures are going to be in place in these various different locations for us to really understand and think about? I also, as I think through your framing and the sort of the real questions of risk and of catastrophe exist, I note that there's greater automation happening amongst industry. So in Fortune 500 companies, almost half are investing heavily in robot processing automation. So in truly automating business processes end to end in a way that the end consumer doesn't understand and recognize. And almost a quarter have completed the automation of one major process. And so, I think about all of these different activities with an ever-present role of threat actors in this space, what that's going to look like. And so I think your framing question is dead on here for us to really think through, and the conversation about what this needs to look like is incredibly important as well. Because I think with all of this greater complexity, all of this automation, all of the devices that are in the environment, I do wonder if we have reached the end of our current construct of control theory, right? We think about how we automate the interconnection of all of this, and so much of our modeling is dependent upon how we expect these things to operate. And if we can't depend upon that, then how do we successfully understand what the catastrophe might be or what the impact might be going forward? So I think it's a really rich dialogue you've put forward here for us to continue to evolve on, and I look forward to it.
Thank you, Bobbie. The edge of control, really well. Okay, moving on to thank you. Moving on to Maya. What is Swiss Re and your perspective on this?
Yeah, thank you, Itai. Thank you very much for giving me the opportunity to contribute here. I think I can build on what Bobbie has just said. Cyber risk or digital risk is really the dark side of the ongoing digitalization that we see. And in insurance terms, this is a risk that is prone to accumulation due to this inherent connectivity, but also to the monoculture technology or concentration in the marketplace, just as Bobbie has already mentioned. Now, if we're looking at truly catastrophic cyber events from an insurance perspective, right, first and foremost, what we see here in terms of size would be an attack on critical infrastructure. And Itai, you have mentioned the attack on the Colonial Pipeline. While that is had serious implications for thousands of people and a lot of businesses, that's not yet the catastrophic event that we are talking about here in insurance terms, right? Probably the biggest scenario that we are currently thinking of is a prolonged and widespread power blackout, for which loss estimates reach up to $1 trillion US. And important here, really, really important here to understand is the biggest part of those losses are currently not insured and not insurable, really important. Another high impact scenario would be a mass distribution of malware. We have seen that in 2017 with WannaCry and NotPetya. SolarWinds is another case more recently. And here model predictions for these types of events go up to about $200 billion US of economic losses, for which only about up to 15% would currently be insured. One important also here, one data point for you to put things into perspective, right? If we take this mass distribution malware scenario, the 200 billion and the 15% insured, that would wipe out the current affirmative cyber premium 4 times over. So just to put things into perspective, right? I think it's always good to compare. So if we take other catastrophic events, say the Hurricane Katrina, right, in 2005. Here, the estimates on losses went up to $160 billion US, which insurance paid out roughly $65 billion US, which is about 40%. So same order of magnitude in losses as with the malware scenario, but way higher insurance payout. Important here is also those payouts included publicly insured losses by the FEMA National Flood Insurance Program. So here we already see there is a connection between a kind of a public and private schemes. For insurers, these disaster scenarios are really important to understand because they include them into their own, or we include them in our own internal risk models, which in itself then has an impact on our capital requirements and our financial figures. And that also contributes to the decisions we take in terms of capacity models and how much risk capacity we are actually willing to put out there in the market and help ensure the economy and the society. Right. And I think what we have seen, or what I've said, some of these events, they surpass the private insurance industry's ability to bear those losses alone. And I think for these kind of catastrophic events, a public-private partnership approach is needed, as we see in other areas. And that is important to be able to build these protection schemes that businesses and people can be protected, but also allows insurance and reinsurance carriers to put out large amounts of risk capacity without endangering their own balance sheet. And I think, Leigh, if I'm not mistaken, Leigh will talk about some of those mechanisms that can be employed, like pools or government backstops later. So I don't have to go into this in the short amount of time I have, because there's other things I want to mention here. It is extremely, extremely important here also to always keep in mind that cyber risk, digital risk is not a national problem. And if we are tackling it from a national perspective, that will always fall short. So it's extremely important that we kind of have a high level of international collaboration, and that is a real must. I've said earlier, these attacks to the pipeline, for example, that wasn't yet the big cyber catastrophe yet. But what we see is currently the insurance market is really inundated with a flood of these attritional losses, normal cyber risks losses, right? And the ransomware epidemic that was just recently named a matter of national security in the US, I think that shows the overarching level of risk that we are talking about here. With that comes for the insurance industry deteriorating loss ratios. Itai has already mentioned that. Insurers have adjusted rates, but they are also reevaluating their strategies around cyber risks. That could lead to reducing or is leading to a reducing of line sizes, so how much capacity they are putting out for single risks, adjusting underwriting standards, or even exiting the affirmative cyber insurance market completely. Now, I think it's important that we think through what could happen if the risk and loss level continue to rise. At some point, rate increases would make insurance unattainable for many businesses, and some businesses or organizations become uninsurable risks. And even more insurers might make take the decision to not to offer cyber coverages anymore. And I believe we can here draw some parallels to the liability crisis in the US in the 1980s. And here in March 1986, the headline in the Time magazine read, "Sorry, America, your insurance has been canceled." That is quite telling, right? Because insurance allows for so much business to run and for so much innovation to happen. And this crisis in particular had a huge impact on many people's daily lives, as well as on many organizations who could no longer offer their services because they could not obtain the required liability coverage. So here again, I think this is important to keep in mind. In that context, I believe managing cyber risks, and with it the possibility of transferring risks, has become a part of the cost of doing business. And I think this is important, and I think Bobbie has already alluded to it, so we can have the necessary stability and security that we need to operate. So the big question is also here, what needs to be done and who needs to do it? I think a clear to-do is there for the insurance industry. We need to continue to better understand and model the risk. And that might, for example, include pooling data. That is currently not really happening. We have had several promising initiatives which were abandoned at some point. I think that might still be something that is important to do. But also we must bring sensible products into the markets that are risk adequately priced, and especially important that it supports and fosters good risk management practices, which brings us to what companies and organizations need to do. They absolutely have to increase their cyber resilience. Next to prevention and protection, preparation for the event is crucial here. And in order to do this, I think business leaders absolutely need to acknowledge the strategic and operational nature of this risk. And the public, customers and consumers need to understand the importance and the impacts of cyber risks and demand secure products and services. And I don't know who has listened in to the earlier session on IoT and security in that field. I think that was an excellent example for exactly this point. And finally, governments, they need to set the right boundary conditions and support their economy and their private citizens. And this is especially important since the actions of the government actually might influence the threat level their economy is facing. And this can include, for example, passing the right laws and regulations, for example, with respect to cryptocurrencies, here again in the ransomware cases, but also supporting standard setting. International standards can play a crucial role for regulators to get things right and to avoid new barriers. This was, for example, also emphasized at a recent event of the Geneva Dialogue on Responsible Behavior in Cyberspace, and brought together regulators, industry, and standard-setting organizations. Again, here we see that convergence of the different players who need to act. Again, in this conference on Wednesday, we'll have more discussion on this exact topic. But also here for governments, important the international alignment, and they can also do practical things like raising awareness, data sharing, or even running support centers for the economy. So what does that mean? I think it shows clearly that we need to work together so the cyber insurance market can function in the way it's intended to, and that it is the best effective. And there are a lot of initiatives and groups that are tackling parts of this. I think we are discussing the right topics right now, but we also need to start implementing some of the solutions. And with respect to truly catastrophic events, I think we need to start designing and building the solutions now. We cannot wait until the Big Bang happens. And we have seen that in the pandemic, right? We knew that was coming at some point. We underestimated the impacts, but let's not wait for the big cyber bang to happen and not be prepared. So we should start now. And that would actually have been my last sentence if I had not looked back into another OECD conference I participated in 3 years ago. And I looked into it and I found my preparational material, and I finished with exactly the same call to action. And 3 years later, we are only marginally closer to the solution, but the problem has not stopped developing. And I think now the Leidensdruck is big enough that we should really start working on those solutions now. Thank you.
Wow, thank you very much, Maya, and for being by the side of this terrible issue for a long time, and high persistency. You've depicted a great picture of what the players should do. Thank you very much for this. Peter, I turn to you now. How do you see it from a strategic point of view? How do you see the problem of cyber insurance and cyber catastrophes?
So thank you. It's a privilege to participate amongst these panel members. I feel like I'm fortunate enough to stand on the shoulders of giants who've just gone before me. When I try and picture this, I say to myself, it's just getting bigger and more complex. And that's because of digital transformation being enabled by cloud service adoption. And the challenge, as it gets more complex, is how can we continue to know enough about the risk to be able to manage it on a global basis. According to the organization Research and Markets, the spend on cloud services will grow at 17.5% a year from 371 billion in 2020 to 830 billion in 2025. Meanwhile, Gartner and Forrester both expect every entity on Earth will have some sort of reliance upon cloud services by 2030. In the light of the economic pressures resulting from the tragedy of the COVID pandemic, it seems some of the most significant industrial sectors pursuing and accelerating their digital transformation. So, for example, oil and gas majors are betting the farm on digital transformation to enable them to meet the critical environmental shift the world is now demanding of them. And they are describing this decade as the critical decade that will enable our carbon neutral world and limit the temperature rise to 2 degrees. The scale of this digital enablement through cloud adoption represents a surety challenge, surety being a combination of resilience and robustness. And there is a significant associated insurability challenge. So looking at those in turn, The surety challenge we see, hyper-aggregation amongst the cloud service providers, CSPs, where there is little or no interoperability and redundancy. Aggregation of single points of application vulnerability like SAP in the ERP world. The volume and the cadence of workloads and transactions associated with scale of cloud take-up means there has to be automation everywhere, crypto everywhere, Kubernetes everywhere, and failures are inevitable, meaning the scale of the non-malevolent threat surface from errors and omissions is going to increase dramatically. Aggregation through critical common sourcing, like the silicon underpinning the CSP's offerings, geographical concentration of data centers on the same technical parks, and physical vulnerability of infrastructure like undersea cables, as well as those natural phenomena that disrupt sensitive electronics like a solar flare event. So all of these issues play across a world that is more dependent upon digital assets than has been the case before, and sadly means the digital economy is going to be a lot riskier with less surety of service provision than will be required to keep the plate spinning. There is, as a consequence, a multifaceted insurance challenge. Digital transformation means much more complex and interdependent value chains enabled by third-party cloud service provisions, this X as a service construct. And these complex value chains are enabled in a highly interdependent, multi-cloud world, as Bobbie said, at the edge, and it means will be really difficult to get close enough to the risk to be able to know enough to underwrite it. In fact, today, most insurers' starting point is to exclude outage of external networks. And if we do that in 2030, when every entity on Earth is reliant upon third-party networks and services, there will be no cyber insurance being written and no cyber risk capital available to help lubricate a fully digital economy. Okay, some might say, well, why would that matter? Well, simply, with ever more reliance placed on third-party service assets, there's a major shift in the shape of enterprises' risk profiles, with a very significant increase in the proportion of business interruption risk being associated with these intangible third-party digital services. So in a much riskier digital world, the inability of the insurance industry to underwrite this new business interruption risk is simply a non-starter. But there's a big related issue, and that is cyber risk capital capacity. And already we're running out. We've heard about the attritional ransomware losses, in particular in the last 24 months, that have scared some capacity out of the market, sure. But the material issue is the uncertainty in understanding and quantifying the catastrophic and cascading cyber events. The nascent art science of quantification of cyber risk is not trusted or widely adopted. And this means there is little confidence within the reinsurance sector to bet the farm on cyber risk. This creates a glass ceiling in capacity with reinsurance, and the very same lack of confidence in alternative capital markets means there's a reluctance to share the reinsurer's risk, and that just serves to reinforce this capital crunch. This is happening despite all markets struggling under the burden of globally long-term low interest rates and a near desperation to find higher return instruments, and where cyber ought to be an obvious opportunity. This capital capacity issue is exacerbated by a global shift to respond to the silent cyber issue, which means there is a growing demand for cyber insurance for gaps in cover that this response to silent cyber creates. Now, this is all an uncomfortable combination of issues. So what needs to be done? At the highest level of the hierarchy of needs, we need to agree a shared government, private sector, ownership and responsibility model for X as a service. This will require understanding digital risks within an all-risk framework, cataloging critical choke points so we can dilute their likelihood, bound the exposure, and reinforce the surety we need through meaningful redundancy and interoperability of cloud service provision. Quantification of cyber risk here is key, and we need to enhance the appeal and confidence in cyber risk to reinsurers and alternative investors to stimulate trade in cyber insurance-linked securities, which will demand trusted, evidence-based, auditable quantification of cyber risk. Now, how does failure to address these issues affect the global digital economy? Well, the genie's out of the bottle. The world has gone digital and is busy going cloud. A world in which there is no surety of continuity of services underpinning digitization, and where there is insufficient cyber risk capital to underwrite new, agile business models, will mean there is structural existential risk to significant swathes of the global economy. Certainly, the significance of digital transformation supporting a transition to a carbon neutral economy by 2050 can't be underestimated. And if ESG ambitions are not met and big oil can't transform, our ambition to limit global warming to less than 2 degrees seems out of reach. The time to act is now, to Maya's point, and what we do in this decade will shape the future of the rest of this century. We need to build the surety around our digital world to match the level of our global ambitions. Thank you.
Wow, Peter, thank you very much for that. I think the framework you've just offered us is really slicing down the different scenarios, what could happen and how should we prepare for them on the security and insurance level. Thank you very much, Bobbie, Maya, and Peter for this first part of the session. So now let's move forward to the policy response. After hearing a lot about the problem and problems of cyber catastrophes and cyber insurance, we move on to Leigh and Ellie. Please share with us what you see as possible policy options for the problems that have just been raised. And maybe over than that, what could we learn from other perils, maybe even the COVID-19 epidemic specifically? So Leigh, why don't we start with you?
Thanks very much, Itai. So yes, absolutely. Thanks very much for inviting me to contribute to this discussion. I'd like to build on some of the points raised by Maya and Peter with a focus on how the insurance sector and governments collaborate to ensure the availability of insurance coverage for other catastrophe risks, and then try and share some thoughts on the relevance of these practices for cyber catastrophes as sort of one area where policy could respond to the challenges that were so well explained by the three previous speakers. So catastrophe risk insurance programs or loss sharing arrangements or public-private partnerships are not that rare. In fact, our research suggests that such programs exist in one form or another in about half of all OECD countries. So basically what these are is they are any type of arrangement that's been established within the insurance sector to mutualize exposure to catastrophe risks, always with some form of government moral backing and often with some form of government financial backing. These arrangements might involve the establishment of a publicly owned insurance or reinsurance company to provide coverage for certain or many catastrophe perils. For example, in Spain, there's a public insurer that assumes all the risk from floods to earthquakes to terrorist attacks. Or it could simply be an industry-led co-insurance or reinsurance pool that assumes all losses from specific catastrophe perils and then shares those losses among members in some proportion, usually based on market share, and potentially also with government, especially in the case of extreme losses. Many of these types of programs exist for terrorism risk, for example, in Belgium or the Netherlands or France or Austria, and also for natural catastrophe risks in places like Norway and Switzerland. These programs differ in terms of the types of perils that they cover, so terrorism, earthquake, flood, or a broad range of catastrophe perils, whether they make coverage available to households or businesses or both, the type of coverage that they provide, insurance or reinsurance or some form of co-insurance, and also the role that they play in the market, whether they are sort of the only or the dominant provider of coverage, or whether they focus only on policyholders that have challenges accessing coverage in the private market. These types of programs exist in places that accounted for approximately 40% of all wind and storm and flood losses, and about 80% of all earthquake losses in OECD countries since 2000. So basically, they play a large role in countries that are highly exposed to specific perils. Most, but not all of these programs were established in the aftermath of a large event that led to withdrawals of private insurance coverage in the market, things like events such as September 11th or the Northridge earthquake, or Hurricane Andrew in the United States, or the Wairarapa earthquake in New Zealand, the Nagata earthquake in Japan, or Marmara earthquake in Turkey. In some cases, they were set up because of persistent insurability challenges over many years, such as in the case of Flood Re in the United Kingdom, or the recent announcement to establish a cyclone program in Northern Australia. There is evidence that many of these programs have been successful in broadening the availability of affordable coverage for the perils that they target, and also in protecting government balance sheets, as there have been very few instances where government backing has been triggered. So why do insurers pull out of providing coverage for specific risks? I think Peter and Maya have already given you a very good overview of why that could happen in the case of cyber. But to bring it back sort of at a higher level, there's usually a number of reasons, but I'll talk about three of them. First, it might be that it's difficult or even impossible to confidently quantify the potential losses that could be incurred. The magnitude of potential losses is simply too large relative to the amount of premiums that insurers collect or could conceivably collect. And thirdly, there's no ability to meaningfully diversify the risk based on differences in policyholder characteristics, such as location or sector or size, which is basically the essence of the insurance and particularly the reinsurance business model. I think, as this audience knows well, all of these could easily be applied to cyber risks. So are there signs of insurability challenges in the cyber insurance market? I think we can probably all agree that there are, and especially over the last couple of years, you can see it directly in the financial performance, as Itai mentioned, as well as others. There is limited trust in the existing models and analytical tools, which Peter alluded to, for quantifying cyber risk, which limits the amount of capacity that insurers and reinsurers are willing to provide. And maybe as a result of this, there are very low limits in cyber insurance policies, significant use of reinsurance, probably more than in other lines of business, and very little excess of loss reinsurance available, which suggests that insurers are uncomfortable with providing significant coverage and that reinsurers are uncomfortable with assuming the truly catastrophic cyber risk. So is it enough for governments to provide backing or otherwise support a catastrophe risk insurance program for cyber catastrophes? I'll offer a couple of thoughts on this. First of all, many of the existing programs that do exist are focused on households and not businesses. Governments usually will have a greater interest when households with more limited financial resources can't get the insurance coverage for the risks they face for their most valuable possession, in many cases, their homes. Secondly, where governments have backed coverage destined to businesses, it has often been to protect against some broader economic implications, such as credit restrictions or a lack of liability coverage, such as what Maya mentioned in the 1980s in the US. So this was the case after September 11th. Commercial property developers and owners could not get financing without insurance coverage for terrorism, which insurers were unwilling to provide. There are some concerns that this could be occurring, or this could occur or may occur as a result of the application of COVID-19 exclusions to liability coverage now, which if it materializes could hamper the economic recovery. I'm not sure that this is yet occurring in the context of cyber risk. I don't think businesses are yet losing access to financing as a result of a lack of insurance coverage for cyber risk. Although I did see something last week that there is some evidence that data breach victims, for example, are facing higher borrowing rates from their banks in some places, which might be a sign of things to come. The one other consideration I would add is more of a political dimension. So I've heard it suggested a few times that one of the causes of terrorism is a government's foreign policy, whether that's fair or not. And that one reason that governments should bear the losses from terrorism is because it is their policies that are ultimately being targeted, not the sort of the actions or the policies of the victims. As we know, cyber attack actors with the greatest ability to inflict significant damages and losses are often the politically motivated or state-backed attackers. So does this potentially justify a government role in assuming losses? So far, it's somewhat of a hypothetical issue, not because obviously there aren't politically motivated attacks doing lots and lots of damage around the world, but because cyber insurers have not generally denied claims because of the motivations of the attacker. The cases where they have mostly been, I think many of you are aware, many will be aware of some of the cases where that has occurred, although these have been mostly in the property insurance market, not in the cyber insurance market. That said, insurers are clearly looking at this and how they should apply war exclusions to cyber policies in the future. Despite this hypothetical nature, some governments have decided to allow for the inclusion of cyber losses in their terrorism insurance programs. So for example, in the UK, Pool Re has taken a number of proactive steps to define a coverage for cyber terrorism. In France and in the US programs, they have taken steps to clarify definitions to ensure that some of the coverage, some coverage is provided for cyber attacks, terrorist attacks that occur through cyber means. In Australia, this is being seriously examined, I understand, although not yet with a decision being made. Of course, all of this depends on the ability to attribute the source of these attacks, which of course has its own set of challenges, and is also likely part of the reason why insurers are still paying out losses resulting from politically motivated attacks. Ultimately, I think some form of government-backed insurance program for cyber catastrophe may be needed, although having seen, especially from the experience with COVID-19, I'm not sure that the usual set of public policy prerequisites have yet been met. Doesn't mean we don't need one, it just means, I might be a little bit pessimistic that anything will happen until it is needed. I'll leave it there. Thanks, Itai.
Well, Leigh, thank you very, very much for that amazing maybe depiction of what our governments, what can do in other perils and what's holding them back in acting on cyber. With that, we'll turn to Eddie. Just a second before that, I will encourage the audience, please use the question box to ask us questions. We are getting closer to the Q&A session. We will appreciate your questions. Eddie, please, the floor is yours.
Thank you. Well, thank you to the OECD and to the INCD collaboration to put this together in general, and the cross-working groups in the OECD in particular, which I think is so important to tackle such a complex issue. Let me try and tackle three issues that in many ways is a hybrid of all the smart things you've already heard. And I won't say many original things, but perhaps try to put them together in some fashion. So the first point I want to make is that we fully appreciate what is at stake. And what I mean is not the catastrophes, but what is at stake if insurance wouldn't be able to perform an effective role in the digital economy. And here we have to understand that what is at stake is a great deal larger than just risk transfer, because insurance is a depository of data, and it's a remarkable analytical power to digest it. And it's a soft regulator and enforcer of norms. And it's a natural harmonizer of those norms. So even if states can't agree, insurance can play that role. And it's a catalyst for government action. And it's a hook for other financial institutions to come in and assume some of that risk. We have already mentioned cat bonds and so on. It's an investor in technology to mitigate some of those risks. Lighthouses come to mind, with shipwrecks and so on. It's a role model, as it has played the role with climate, for example. And more recently, we've understood the role of insurance as a secure island that must protect its own data or else give tips to potential cyber malicious actors who figure out what they can actually ask by way of ransomware and so on. So I think fundamentally, everyone needs to understand that this is not the myopic interests of those who are already in the business and make their living of it. But if somehow insurance won't be able to play their role, we, as a sort of with the digital economy, are in jeopardy. So maybe those who grew up in this domain tell me, Ellie, you haven't said much. You could have summed it all up by saying insurance is risk engineers. And I think, yes, that's very much true, except risk engineering with the digital economy assumes a completely different meaning. And everyone that preceded me tells you we're thus far headed in the wrong direction. So that's point one. Point number two is to think of the sobering lessons of the pandemic. And I mention this because I see, and I think in the presentations before me had already highlighted, that we are already seeing some of the same problems in terms of how we understand the risks and how we manage them that are beginning to play out in the digital economy and are quite worrying, and therefore are a kind of a warning sign that we need to take it seriously, even before we refer to Maya's concluding remark that she said the same thing 3 years ago and nobody really paid attention. But in the meantime, there has been a pandemic. What does the pandemic teach us? That the reactions were individualistic and nationalistic, and the solutions inequitable, and the perspective that was adopted was myopic, and the reactions were improvisational, and they were politically charged, and that in trying to understand the nature of the pandemic, we had to contemplate natural causes, human errors, tech failures, and malicious action. All of those combined, each of them individually and all of them combined, could produce those effects. That whatever started in Wuhan didn't end up in Wuhan. This is global and cross-cutting, and look how quickly it spread and so on. That the effects are greatly exacerbated due to business practices. There was already a mention of just-in-time, supply chains, standardization, or the way Maya referred to it as monoculture, and so on. And that perhaps most intriguing of all, the acceleration of the digital enablement as in light of the pandemic that made it possible to manage some of the effects of the pandemic, but at the same time rely mostly on legacy systems and their adjustment and adaptation as an improvisation to facilitate it without the infrastructure actually being able to support the risk management and understand the risks we assumed in the process. So where does this leave us? Let me now try and offer my very personal thoughts, and bear with me because I am bringing in a public policy perspective rather than insurance as such. One that we have already, I think, alluded to, we're talking about digital rather than cyber. All risk approach, malicious, non-malicious, man-made, natural, and so on. Clearly, that already means we have to move from cybersecurity to robustness. And one of the biggest challenges associated with that transition is that we've set up a lot of cybersecurity agencies across the world, but their mandate is inherently quite restricted. They don't have any authority of the others. So here we also have a bureaucratic challenge. The second one, assume that failures are inevitable. Those who have benefited greatly from the digital enablement have a hard time acknowledging that failures are inevitable. We have already heard from Bobbie, from Maya, from Peter, and so on, that failures are inevitable. And they've already happened. But Bobbie has already mentioned one case in point. There are others that have occurred since, even in December and so on. And that the failures are going to be much more consequential because of the same concentration factors that Bobbie has mentioned, or the monoculture problem that Maya has referred to, and so on. So we need to understand that we need to complement, and I think Peter already said it quite nicely, to complement a robustness with resilience, and hence the term surety that Peter has already referred to. The third, we have to understand that whereas most of the problems we have encountered to date are problems of availability of the digital economy, namely sort of that the service may or may not be available, going forward, and particularly in light of the technological sort of trends that Bobbie has alluded to, the problem of integrity may be just as acute because things would be less well understood by us. It would be automation and artificial intelligence and so on, and corrupting them, depriving us of the confidence that we can entrust them, could have potentially catastrophic consequences. So I would add to the scenarios that Maya has already mentioned. So we need to think of expanding the scope of the potential catastrophes and so on. Fourth issue is how do we bound effects? Understanding bounding effects. I think here collaboration is absolutely essential, including collaboration from those who thus far did not feel that they have the duty to engage in that kind of an experience. So it's not just understanding. It's given, here is the flip side of the concentration that Bobbie has talked about. Here we need to tap those handful that provide 80% of the CSP service or 55% of the SaaS service and so on. It's just in the hands of a few. We need to tap them to play a key role in bounding effects. Interoperability was already mentioned. Dealing with some aspects of the monoculture and so on is another one of those aspects. There are many others, so dependency on the common silicon that Peter has already mentioned and so on. And clearly we need to do it across sectors. If I mention now, we haven't mentioned the financial sector, but the financial sector, if integrity is compromised, not just availability, we are in deep jeopardy and so on. Shared responsibility has already been mentioned, and I think is a critical thing going forward. Shared responsibility between consumers, providers, and governments, and where insurance can actually come into the equation and assume some of those, assume some of those, and aligning the responsibility and the liability alongside the benefits that you have, and so on. Insurance, I think, could play a role that we haven't mentioned thus far, and perhaps will be truly innovative in being de facto regulator and sort of auditor of those. The governments cannot keep up with the technical evolution. The governments cannot be effective regulators. They are trying to certify things. They're falling behind or stifling innovation. If insurance is a real risk engineer, as I think it can be, it's part of the regulatory framework that would, on the one hand, enable technical evolution, and on the other hand, would reassure government that someone with a skin in the game can actually help them understand the risk and manage it and so on, and they just need to complement and so on. We need to develop collective approaches rather than individualistic approaches and so on. And finally, my final thought is as follows. I think the OECD could play a huge role. I'm looking here at Laurent and the others, members of the team, Leigh, and so on, to raise awareness, to engage in cross-cutting efforts between and across the OECD in setting standards, in identifying best practices, and in developing guidelines. And I think this forum will help take us quite far in that direction. Thank you.
Thank you very much, Ellie. It's been fascinating. Feels as if during this discussion, so many different framings or parts of the same mega problem have been risen. And this is, well, as it is with complex problems, you always have to start somewhere. And more concrete point of view, what do we actually do tomorrow morning? And with all that massive and thrilling and fascinating thoughts, that all the points that you've made. So I want to thank all the speakers for your job so far, but now we move on to the Q&A, and you'll have more job to do here. So I'm quickly looking through the questions. We'll start with a first question, maybe for Maya. There's a question from Jonas Gratz-Hoffman about the previous efforts of the insurance industry to harmonize the risk categories of cyber, and why did it fail? Could you help us with that?
Yeah, sure. Thanks, Jonas, for that question. I'm not quite sure whether the efforts to harmonize the categories failed. I think there are some good kind of agreed joint categories out there. There was an enormous amount of work done with the help of many insurance carriers and reinsurance carriers and researchers to come up with, I think, a good categorization, a usable categorization. I think the problem is more that this now needs to be used and used widely and implemented in a way that we can use it for data sharing purposes wherever that is allowed and brings us forward to understanding the risks better. So I think the problem sits a little bit in a different area, not in the categorization itself, but in the usage of that one. That's at least my opinion here. Thank you for the question. It's a good question.
Thank you, Maya, for that answer. Moving forward, we have a question from Ghislaine, simply asking that some insurance companies are advising the policyholders that are hit by ransomware to actually pay the attacker, to pay the ransom, because that would result in lower costs. And the question is whether that challenged our assumption. We have a working assumption here that cyber insurance will for sure lead to mainstreaming best practices. Is that trouble? Peter, what do you think about that?
So I think there are a couple of reflections. The first one, of course, is that jurisdictional challenges in terms of the definition of penalties and fines play across the nature of the response to ransomware. So it isn't always the same kind of answer. But I think as an overriding view, it's not going to undermine, as long as the insurer's expectations of cyber readiness in enterprises remains high and relevant, and that those expectations are reinforced by ongoing policy evolutions. Simple truth is that for some entities, ransomware attack will represent an existential issue. And under those circumstances, not paying the ransom is, again, a non-starter. Other organizations have different challenges. So my sense here is that, as is always the case, insurance and the role of insurance in these challenges is part of a broader range of responses. And insurance doesn't replace and will never replace good quality management of the risk that is at hand. It will augment and support that.
Yes, thank you very much for that, Peter. Have another question. Well, it seems that cyber insurance does require some, not a merger, but at least two body of knowledge of cybersecurity and insurance to come closer in order to manage this. And this could be a question for Ellie and maybe for Bobbie as well, and maybe you both could answer. What do you think, what is the part of corporations, of technological corporations, to put forward in order to get better advancement on the issue of security and insurance? What is their commitment to this issue of cyber catastrophes? Ellie, why won't we'll start with you?
I defer to Bobbie first.
Okay. Bobbie, you've been chosen by Ellie.
Always a privilege. So when I think about the piece, I actually think the framing of the question is not quite right. And that's that it's not so much that cybersecurity and insurance need to come together. It's that expertise in the digitization of business and life and insurance need to come together. Cybersecurity is just one of the possible risk areas, or the loss of cybersecurity, the consequence of doing it poorly is just one of the possible consequences that need to be considered. And so really understanding what and how we are digitizing the sum of the business processes, I think, is really an important thing. And when I think about it from that construct, I think that it's very important that corporations, that businesses really understand what their business processes are and think deeply about how they transform them into an automated or into a digitized state. And that as a part of doing that, that helps them understand the risks to the business and increase, I think, Ellie, you used the word robustness, and overall resilience of that execution activity. And when they do that, that I think is helps folks look at the problem more holistically for them and for whatever business they're in, right? It's difficult to make broad generalizations given the wide range of business activities that occur. However, I think Peter pointed out, they're all incredibly dependent upon this digitization to meet not just their business objectives, but their social objectives as well.
Itai, now if I may, I knew I had a sense of what Bobbie was going to talk about. And she's absolutely right. But let's ask ourselves, why isn't it happening? It hasn't been happening because there hasn't been too much of a pressure on those providing the services to actually offer that level of engagement. And at the same time, they have been extremely busy, not just innovating their services and extending them to others in order to cope in part, with the pandemic and so on, but also responding to huge attacks that they have been experiencing, so the SolarWinds and the Hafnium and so on, not to mention others just in recent months. So they have been the people who can really help manage those risks and talk about them have actually had their hands full of trying to deal both with onerous government regulation on the one hand, technical evolution on the other hand, and responses to catastrophes on the third hand, catastrophes from a corporate perspective. While at the same time, there hasn't been an effort by either the governments or the corporations, for a variety of reasons, to hold them to account. And hold them to account not because they are entirely to blame, but make the responsibility model better understood, and the adjudication of liability something that not only is better understood, but also is more equitable. And here is where I think the OECD could play a role in terms of aligning expectations of what is it realistic to expect. I think the one issue that all of us here in this panel would agree, third-party dependency in whatever area it is, chips as we're now seeing in almost every industry, or digital enablement is a huge, huge issue, nowhere more so than in the domain we're talking about. How does one adjudicate liability in this respect? And how do we deal with this together? I think is the biggest problem in front of us for the coming decades. And that's where we need to try and set up some reasonable guidelines.
Okay, maybe break down the silos as it is so urgent to do. Thank you, Ellie and Bobbie, for those answers. Wait, I think, bear with us for a moment, then we have one more question. Okay, the question from Ariel Weiler. I think it'd be great to take it to Maya and Leigh as well. So in the past 2 years, we observe an increase of attribution of the malware attacks to certain countries of origin, even not directly linking them to any specific government, but we do have a linking to a country of origin. And how does this hybrid form of conflict influence the insurability of major events? Leigh, we start with you and then on to Maya. Please, we only have 2 minutes or so for this answer.
Sure, thanks very much for the question. So, I mean, I'm not directly involved. I've sort of been watching this area a little bit, but from what I've seen, as I mentioned, there isn't really, cyber insurers don't tend to exclude and not pay a claim based on the attribution of the attack. The one area where I think that's changing now is in the area of ransomware, because there's been a couple of clarifications put out by some anti-money laundering agencies about, if you have a sanctioned entity that's on the other side of the ransomware attack, then it's actually illegal for insurance to repay a ransom payment made to that sanctioned entity. And so that's one area where the attribution of the attack has become increasingly important. In terms of more generally, if it's outside of ransomware, from what I've seen in the insurance sector, I think what is being discussed is something around exclusions related to the magnitude of the attack. So if you are in a situation where there is a some kind of link to government, I know the question wasn't only about links to government. If the attack is of a certain sort of destructive nature of a certain level of losses, then there might be some sort of exclusionary language being developed to sort of exclude that from insurance coverage. But Maya, I'm sure you're much closer to it than I am, and Peter as well.
Yeah, no, I think Leigh, you have lined it out very well. I think there is, very kind of specific cases, as you said, in terms of, who can you actually pay, who are you allowed to pay, are you legally allowed to pay, right? That is one aspect. The other aspect is on attribution. It's often linked to state aggression discussions that we are having, and has been a very hot discussion, I would say, in the insurance industry for the past 2 to 3 years. I think we've been making progress in thinking that through in my experience, and that is I must put this out here, is limited in that space. Is I think attribution, if we connect directly to attribution, is always difficult, because there might be attribution that is done, but the question is always for the insurance, is that going to be holding up in court, for example, as well, right? And that might be different a level of trust you put into the attribution than in other cases. So yes, I think the issue is still here in terms of how can, or what role does attribution actually play in paying out cyber claims. And I think that is an ongoing discussion that hopefully will be solved at some point very soon.
Okay. Thank you, Maya. I'd like to conclude for a moment and then allow each of you last few sentences, please. And I'm going to be, Ellie, I see you have your hands raised. Ellie, would you like to comment on that?
Yeah, I wanted just to add, to complement the answer on the attribution, and say the following. I think we have a similar problem with what I would call characterization, because we have tried to understand what constitutes war in cyberspace. And that has been difficult as it is. But we now are trying to understand what constitutes, a normal intelligence operation, which penetrates your assets and so on. What does other types, and just even diagnosing, is it really a ransomware attack, or is it something else? Is as big as a challenge of who carried it out. And if we do manage to find out who carried it out, on whose instruction was it? Was it a piracy operation, a privateering arrangements and of some kind, or was it state sanctions all the way and so on? So I'm slightly less sanguine than Maya in being able to solve that problem. But I think what Maya is absolutely correct is that the insurance is getting better at figuring out what can you do if attribution becomes an iffy proposition.
Okay, thank you for that. So a very short conclusion before I let you guys have your last words here. So I think this is a really fascinating story we have, right? We have geopolitical wars in the background between nation states. We have a technology speed of things. Things speed up very fast and change all the time. There's a security matter here, and maybe an ambition of one industry to try and maybe map out things and have them in categories so they could simply be put into business models and produced for the entire economy. So I think the story here is very interesting. The complexity is of high complexity, involving nation states, governments, multinational organizations, and of course businesses and exploiters and software developers and so on. But it does require some understanding of what our next steps should be. Should it be within the OECD or maybe other platforms? How will the insurance industry show leadership to join together and maybe boost things maybe a bit faster than the rate they are boosting this right now? Many questions rise on that. I would like to thank all of you. And just before closing off, a short last comments from each. Leigh, we'll start with you, then Peter, Bobbie, Maya, and Ellie again to finish. Thank you.
Sure, thanks. I'll be very quick. So I think as everyone has seen probably many times, I mean, the world is shifting from physical assets to digital assets, and it's clear that insurance needs, insurance has always played this risk reduction incentivizing role, and it's clear that we have to get this solved, especially as more and more of the assets that are important to our financial markets are digital. We need to find a way to protect that, and that's going to have more. That's going to involve a lot more people than just the insurance sector, but obviously it's critical given this shift.
Thank you. Peter.
Hi, yeah, I wanted to pick up a little bit on what Maya was saying earlier. There are two critical commodities that are at risk as a consequence of this complex interaction. The first one is trust. Trust my identity is secure, my money is safe, my kids are safe, I'm safe at work, my medicines are going to be trusted. Trust I can believe in the things that I see and that I read. And the second is confidence. Confidence that those services upon which I rely, those services upon which economic prosperity and well-being are dependent, are going to be resiliently available. And I would simply offer a question, and it's about this call to arms. How can we engage in a wholly digital world where we no longer have trust and we no longer have confidence? That is a really ugly place to be. And that's what faces us if we don't act now.
Thank you, Peter. Bobbie.
Yeah, hard to follow. I would say I think deeply about the players in this problem, right? So we talked a lot about catastrophic consequences here and aggregation of risk and elements, and we touched on the players. But I think that's a place where much more deep thought needs to occur. We throw around too easily this language of public-private partnerships as though those things appear out of thin air based on will. And really, public-private partnerships are driven by nations within the constructs of each national, both dialogue and structure. And so thinking about how we should and could, I believe that it is the right answer, but I do believe we've got to put a great deal of thought into what this is going to look like, because doing this within a global construct means we have to begin to have some common language, or at least conceptualization of how we assign responsibility between the public side of that and the private side of that. And that, even at that level, that grounding isn't always as easy to find. So
thank you, Bobbie.
Call to action, I feel, but we must remember that the tool we're talking about using needs its own call to action.
Mm-hmm. Thank you. Maya?
Yeah, I'm totally going to steal something that Ellie said in his remarks, and I think that resonates well with me, and I think with everybody else here on the panel as well. Is there is a shared responsibility of us. It's not the insurance industry as such cannot solve those challenges, and the private economy cannot solve these challenges alone. People cannot solve these challenges alone, and governments cannot solve these challenges alone either. So I think this shared responsibility is important, and I know that makes things very, very slow usually, and very, very complex in terms of finding these solutions that Bobbie also now pointed out. But I think this is the right way to go, and I think the challenge is big enough that we can, with a good conscience, put all of ourselves into solving those issues, because it's for the best of all of us.
Thank you, Maya. Ellie.
Let me combine there were lots of smart things that were said, but let me combine just the last reflections of Bobbie and Maya together. What we have heard is that we need to solve it together, and that's the shared. And what we've heard was a little bit of a note of caution that the shared thing is going to be a difficult thing to take to handle. So I think that the way I would look at Bobbie's note of caution is what needs to be the sequence. And I think the sequence ought to be that we first try to come to grips with it without the governments and understand what are the inherent limits of what the private sector, the providers, the customers, and the insurance can handle. And once they have a clue of what there is and where the deficiencies are, then we approach the government and say, rather than having a heavy-handed certification, here is what you and so on, here is the tail end of the risk that you need to, and here are the standards you should enforce. So I think that the process ought to start between the insurers and the major providers of the SaaS and the CSPs and so on. Bring in the major consumers, and then when you have that picture, take it to the governments for the shared responsibility overall.
Thank you, Ellie, very much. I would like just to finish off with Maya's great test for the next 3 years. We should wake up over the next few mornings as if the next OECD convention in 3 years is coming, and we have to not just act now, but clarify and make things more certain on the different scenarios specifically, and not just a broad sense of what needs to be done and how everybody should cooperate. We should have some more specific plans. And with that, I will finish. And I want to thank everybody for working on this session with me so far. And I look forward to working with all of these panelists and other people in the audience in promoting these issues. Thank you so much. And thank you for the OECD. Bye-bye.
Bye, everybody. Thank you.